All right, hello everyone. My name is Oheneba Mayintiose, and on behalf of the Association of Foreign Press Correspondents, I'd like to welcome you all to this educational program on navigating global trade flows in the shadow of COVID-19 and US-China geopolitical tensions. Before I introduce our guests, kindly note that this event is developed in partnership with the Hinrich Foundation and the AFPC, solely responsible for the development of this program. Now to our guest, we're pleased to have here with us today, Émilie de la Bruyère, a senior fellow at the Foundation for Defense of Democracies, FDD, and co-founder of Horizon Advisory, a strategic consultancy with a focus on China policy. We're also joined by Nathan Picarsic, a co-founder of Horizon Advisory, a leading geopolitical and supply chain intelligence provider. And together, look forward to this really great discussion. I'll turn it over to Nate and Émilie, who have a short presentation.
Thank you very much, Hinrich. We're thrilled to have the chance to join the audience today. We're excited to dive in. I don't know if we have the slides pulled up or if we need to pull them up. But either way, we can dive right in. I think in general, we're excited to talk through trends that we're seeing in the macroeconomic environment. We've had the subsequent series of interactions between the ravaging of global trade by COVID-19, dating back several years now, leading into what we think is a fairly unprecedented and unique geopolitical environment today, where the two largest economies in the world, the United States and China, are in the throes of what appears to be a long-term peacetime competition, not dissimilar to the Cold War, but certainly impacted by the nature of today's information technology, the nature of today's macroeconomic globalized world. So I think it's a unique and timely opportunity to dive into these issues, and we do have a few slides that we will very quickly try to pull up from our end. If we can.
Yes, that'll be great.
Okay.
In the meantime, I'd like to share, if anyone in the audience has some questions, do share them in the chat box. We'll have time to go through a couple. Depending on the time we have, we'll make sure we have enough time for a few questions.
Okay, perhaps the slides are now working.
Yes.
Okay, fantastic. So introduction out of the way. The key points summarizing what we see emerging in the current environment. The first is that global trade has recovered from the impact of COVID-19. Volumes, values of trade throughout the global system are rising at this point relative to 2019, and the dislocations that we experienced, the supply chain challenges, the acute shortages that defined the early COVID period seem to have been overcome with not without a vast array of economic impacts and microeconomic challenges, but the big picture is that the macroeconomic environment in terms of global trade has recovered. That said, the experience of COVID-19 certainly has started the process of certain types of trade patterns being reshaped. Certainly the experience of just-in-time delivery of certain components, whether that was emergency equipment or subsequently medicines and normal consumer goods in the United States, for example, have led to both corporates and governments behaving in a slightly new way around understanding their supply chains and the risks that their trade patterns may have invited in the pre-COVID era. So trade's changing. With those changes, we have seen new narratives emerge as well, not just shaped by US-China dynamics, but certainly shaped to some degree by US-China dynamics. Discourse around themes like de-risking, deglobalization, friend shoring, ally shoring, these terms and concepts relatively new to discourse, certainly increasing in salience, both in broad mass understanding as well as in political and regulatory interpretations, certainly in the United States, in Europe, and then critically in key trading partners across the Asia Pacific, including China, but also others in the region that are core trading partners of the West and themselves have different relationships with China. So these narratives have emerged. There's certainly reality that underscores the salience and degree to which these narratives register in policy and in economic debates. But as we see in observed reality, those narratives at this point have not been fully realized. So we haven't seen some broad decoupling of US-China trade. There have been select supply chains that have shifted some. We have not seen complete corporate abandonment of investment into China. Global capital markets have not cooled on Chinese exchanges or on the prospects of Chinese corporates listing in overseas exchanges. The experience of the geopolitical tension we've seen in the Ukraine and the isolation of the Russian economy is not something that seems relevant or replicable in the context of China, even if you're adopting the most hawkish Western view of Beijing. So key takeaways here are that there are these narratives around shifting supply chains. There's a degree of truth that undergirds those narratives, but they've yet to be fully realized. We'll have a few slides to just click through some data points and additional points supporting these key points, and we'll be excited to dive into a more interactive discourse once we burn through them. So COVID trade losses have been recovered. I think the chart here just shows a quarterly index that UN Comtrade generates. Values and volumes of trade are exceeding where we were in the dip that COVID created. So at the macro level, I think this supports the idea that we do have a global trading system. It's even independent of weighting according to macroeconomic performance. Its vitality, its nodes and depth of network remain as valid as they did prior to COVID-19. There are pressures that we think are relatively latent and only partially understood by market and regulatory actors that suggest there's a risk of global trade and the shifts in global patterns of trade having spiky and impactful adjustments in the months and years ahead. Geopolitical trends certainly stand out here. US-China dynamic tensions that are defining interactions between Washington and leaders in China clearly are not reaching some thaw. They remain, filled with tension, filled with risk. At the same time, markets and market participants are dealing with a range of potential technological disruptions, each of which on their own may parallel past shifts in terms of productivity and trade impacts. And we're living through a period now where it feels like there may be several of these types of technological disruptions emerging. Those trends, to some extent, operate independent of the geopolitical features that are also placing pressure on the trading environment. But they work together in concert with geopolitical tensions to generate what we think is a fairly unique degree of instability in the environment. We think that the macro picture that we just looked at in terms of values and volumes of trade increasing to some extent overlooks the bubbling underneath that may be presented by the confluence of geopolitical and technological trends that generate uncertainty for businesses, for market participants, and for regulators and governments that are preparing for these types of trends and impacts. With those underlying tensions, we also see that China's continued to engage overseas as a strong and dominant player in global trade.
And that hasn't changed despite the shift in rhetoric. There have been at various points in this process, spikes of concern or a rhetoric that like China's role within global trade and within global industry is disappearing. That's been the case with COVID-0. It's been the case in the immediate COVID-0 aftermath when it's taken time for China to get its economy up and running. It remains even today with a strong narrative of a sluggish Chinese economy. But even just if you look at this chart, China's global export value remains high, and despite spikes downwards, relatively consistent as a major thing. That said, what that suggests is that if we go to the next slide, like the whole de-risking narrative, both just based on these figures and what Nate's just laid out in terms of continued reliance on the part of capital markets, on the part of major industrial players on China, adds like a level of caution or a reality check to the narrative of de-risking from China. There are some other things, though, that undergird this rhetoric that are worth accounting for, and worth accounting for as enduring trends that aren't going to disappear and that will continue to create pressures or frictions within the overall economic relationship, not only between the US and China, but also between China and the world. And part of that is narrative force, but part of that is US regulations and also European and global regulations, whether those apply to trade or human rights or information protections. But another force behind this is China itself. And that's a critical thing to keep in mind when we think about deglobalization trends. Beijing, first of all, because of the nature of rhetoric, there's often a framework by which the players that are, it's seen as if the players that are driving de-risking or separation are purely US and or Western ones. And that's both because of the competitive and the confrontational rhetoric coming out of those countries. It's partly because China is adept at espousing publicly a line of pro-globalization, pro-no barriers, etc. But if you actually peel off of the surface layer, there's a huge amount of regulatory, especially, but also economic action coming out of China that in fact drives the deglobalization narrative and forces. China's entire economic model is based on establishing relative self-sufficiency. So that at a first level means that one portion of the globalization equation, which is dependence of China on the rest of the world, is, at least from Beijing's perspective, being chipped away at. Another part of this is that Beijing is engaged in economic competition and will use economic tools in order to impose costs on its adversaries, including the US, a reality that further drives the deglobalization, de-risking, whatever we're going to call this environment. And Beijing is willing to do this and is willing to do this relatively aggressively. I think that actually probably takes us to implications and indicators, so I'll turn it over to you.
Yeah, we're excited to dive into conversation around all of these themes and the broad scope that we're covering here, and just want to highlight a few areas where we think that there are both implications emerging from the trends in the macro environment, and also where we may be able to look to see indicators of how these trends are going to evolve moving forward. So broadly, capital markets strike us as an important battleground or fora for monitoring these trends. And there you can observe things like the Chinese government making efforts to induce key global capital markets players, commercial banks who may have asset management businesses in China, to induce them to embrace the Chinese market more moving forward by, for example, changing the percentage that overseas operations can own of their businesses on the mainland. That then in turn also informs how corporate strategy evolves. So where global industrial players decide to allocate their capital expenditure, where they decide to pursue new markets, who their key suppliers, key partners are. And there's a host of examples just in the past few months of China doing its best to encourage engagement with the outside world that supports the asymmetric interdependence that Emily was just outlining from the Chinese perspective. And then in parallel, we also have political pressures that we think are both timely and impactful emerging in the United States as well as in Europe. But I think the United States is an interesting example, at least for the next year or so, where electoral realities are going to increase some of the rhetoric that we've highlighted. It'll be interesting to see where that rhetoric turns into reality and action. And then regulatory enforcement as well. There's been on both sides, as Emily defined, the Chinese side as well as on the American, European, Western side. There have been a host of relatively unprecedented regulatory actions taken. Examples could include the counter-espionage regulations and legal framework that have emerged in China, China's approach to controlling and regulating critical data, which came into play in the way that the ride-sharing giant Didi was delisted from American exchanges, as well as on the American side, actions like the Uyghur Forced Labor Prevention Act give us this range of new and highly impactful regulatory measures that have been taken, but that are still evolving in terms of their ultimate impact on trade and offer, both areas where we see implications and also areas where there may be indicators in terms of how enforcement ultimately comes together and shapes these other factors in terms of how corporates and how capital markets view the future of trading and view these key relationships like the US-China dynamic that will shape the layout moving forward. But we're happy to seize up on our yammering here and excited to dive into an interactive conversation around these key themes. So thank you, everyone.
Thank you so much. Thanks, Nathan and Emily. Definitely lots to unpack here. And I actually wanted to touch on, what you just mentioned about Didi and regulatory pressures. And tying this to the report you also recently published, the Chinese government forcing Didi to stop accepting new users due to concerns over national security risk and data access. I guess my question is, do these tensions, and you've touched on some of that in your presentation, how far do these tensions go beyond security measures? You've touched on economic, maybe you can expand more on that before we dive into the corporate strategy aspects.
Yeah, absolutely. I would start off just from a theoretical perspective, and at the risk of security and economics are very much tied from the Chinese perspective. And so all of these measures are very much both of those things. I think that the data angle and control over the private sector are particularly important or obvious or concrete elements of that integration and the role that the economic level plays here. On the data front, if you look at the Didi case, much of that was driven, or the explanation given by the Chinese government for the whole Didi scandal was sharing of sensitive and strategic data with the rest of outside of China's borders. Why does that matter? It matters from a pure security perspective, but it also matters from an economic perspective because collecting data is valuable. China sees data as a new factor of production and one that can drive economic development as well as national security and as well as power projection. And that ties into the digital regulations that Nate just talked about. Those are very much driven by the idea that if China can control and have an advantage in international data flows, China can gain a competitive advantage economically across the world. And then there's also just the point about asserting control over Chinese state champions, which was an important part of the Didi case and an important part of China's techlash more broadly. What the Chinese government did when that happened was show the rest of the world and the rest of its companies that the Chinese government is in charge, and that they serve as tools to project power and to support the strategic ambitions of the Chinese government, not simply to make their own money. And that is a strategic and economic and a security move.
I would just add no additional detail on the framing, but just because it's kind of a parallel case and an interesting set of indicators, the first Chinese multinational to list in the United States since the Didi incident was a LiDAR company called Hesai, which listed on the New York Stock Exchange, I think the first quarter of this year. So first incident of the capital markets relationship possibly rekindling. Interesting to see where things move from there. And I think it's a ripe area for understanding where trade may follow the capital market dynamics, and certainly where the regulatory environment from the Chinese side may or may not relax moving forward.
That ties in nicely to the corporate strategy aspect, and particularly on supply chain, which you mentioned. I mean, Nate, maybe you can touch a bit on the recent export restrictions, how that also come into play, especially in the trade aspect.
Yeah, absolutely. So I think the big picture is that it's interesting and to some extent unprecedented how trade regulation on both sides between the United States and China is playing an escalatory role in the current geopolitical tension. And I think the moves most recently from the Chinese side of restricting exports of critical minerals like gallium and germanium and a host of others is something that should be perceived, and I think that the Chinese authorities intend to signal is a fairly escalatory and clear signal to re-engage, to force an embrace that mirrors the desired asymmetric interdependence. I think in these critical materials, say gallium, for example, I think the United States imports close to 90% of its gallium from China. So this is a pretty acute supply.
That's huge. Yeah.
The Chinese government and the Chinese suppliers of gallium and germanium are well aware of the dependence that they've sowed, and they're interested in using it for coercive means. That signal, I mean, how it's being perceived and acted on, I think is still very much an evolving dynamic, but it's a clear warning shot from the Chinese side, and that I think portends challenges ahead.
Would you say that, I mean, this position that the Chinese government has taken, does it give it an upper hand? Does it make it easy for the government when it comes to dealings with the West, looking at trade specifically? Yeah, Emily, feel free.
I think Beijing is, I'm not sure this directly answers the question, but Beijing is adept at using its ability to impose trade penalties like this in order to get its way with international partners, even in times of like aggressive rhetorical confrontation. This is probably like most obvious, or like China and Europe are a great example of this. Generally, you'll see if there's a concession diplomatically on the part of a European state to China, for example, or economically or on any grounds, that'll come because there was a trade sweetener or industrial sweetener. Like you see, a new Airbus facility being launched or developed in China. And the reverse also holds. China will punish with trade restrictions, and I think that's very much factored in. So in some perverse way, I think Beijing's willingness to be confrontational over trade and economic relationships actually makes its relationships with the rest of the international system easier for Beijing to handle, because that's a major trump card, considering the country's role economically and industrially in the global system, which is probably just like the redundant way of reiterating that there is all this rhetoric about de-risking and all this rhetoric about deglobalization, but considering how reliant the world is on China and how much China can at the very least offer, if not follow through on, it's a lot of, there is a rhetoric reality gap.
Really. You mentioned private companies, and I want to touch on recent visits, by Elon Musk, Jamie Dimon to China, and some of the remarks they've made on the tension. Musk said that the relationship between the two countries is like that of conjoined twins, and Dimon characterized the relationship as solvable. What do you make of those statements? Do you agree, disagree, and how can they help or sort of amplify the tensions? How are they helping or amplifying the tensions?
Yeah, I think the corporate embrace, and certainly the recent, I think really helps to underscore the unique nature that Chinese economic and industrial policy has played in sowing the type of asymmetric and interdependence I think markets are still coming to terms with. So if you're Elon Musk or if you're Jamie Dimon, you see the Chinese market as an impact for you on both sides of your balance sheet. It helps your costs. So if Elon's able to build Teslas in China for a lower cost and able to export them to Europe or elsewhere and able to be there in a way that allows them to establish better R&D partnerships and supply relationships with Chinese battery makers, he's helping his costs, and he also is induced by the allure of the Chinese market. So wants to sell more Teslas out of the Shanghai facility to a growing EV market in China. So it's both it's kind of a pincer movement for corporates to see that they have both cost and revenue drivers in China. That produces a decision set that's very different from that of a national security analyst or even a supply chain resilience observer. I think the picture is very different, and it serves, I think, a somewhat counterproductive role in terms of the rhetoric that we can see at the surface level. So if Elon goes to China, it draws a lot of attention, and his remarks are likely to be perceived in a certain way. So the positive sentiment that he might signal, the dependence that he's in support of because it helps his bottom line, is not necessarily the one that regulators, policymakers might be taking. And following his lead, following that rhetoric, might lead you astray from the reality of the regulatory pressures that are pushing in an opposite direction. I think there are all sorts of countervailing forces at play here, and yet to be seen how it all shakes out. But certainly I think the embrace that corporate leaders like Elon Musk and Tesla's role in the Chinese market have played even just over the past few months is an important piece of messaging, and may conflate or obscure some of the reality that is taking place, I think, in the regulatory escalation that we see emerging from Chinese and Western approaches to possibly restricting or redirecting certain aspects of the trading relationship.
So how can we fix that? I know that nobody has the outright answer, but how can that be resolved? Is it having, the international business community, being cautious in terms of some of these remarks? What is sort of the recommended approach to take?
I think there's some need for imposing reality and transparency in the way that capital markets treat the relationship. So I think Hesai, the LiDAR company that I mentioned earlier, they're actually, their IPO prospectus, I think, is the only document that you can search in SEC Edgar that cites China's counter foreign sanctions regime and legal architecture as a corporate risk. That risk, though, is a relevant threat to any business that's operating in China or that depends on Chinese supply of inputs to deliver their goods to the marketplace. So I think that's an interesting sort of gap, I think, in terms of transparency. I think that the SEC, other global regulators, still have a good deal of work to do to understand the risks of operating in the Chinese marketplace, the tangents that may emerge from the escalation between US-China or Europe-China regulatory escalations, the impacts that those could have on businesses, and to encourage transparency around those. I think similar degree of encouraging transparency is needed for vetting remarks like Elon's coming out of China, or those of international and certainly American banking leaders who also go to China to curry favor with political leadership in return for the opportunity to underwrite the listing of Chinese companies on Chinese exchanges, to gain increased ownership of their asset management businesses in China. There's a whole host of potential real and perceived conflicts of interest that are at play here that aren't ever made transparent, aren't ever factored into the way that capital markets assess risks around these businesses, and risks around more generally the macroeconomic environment that we're living through. So I think if I had to boil it down to one thing, I would look to transparency and greater information sharing as a way to encourage more realistic and valid statements, and a way to impose some degree of accountability and market awareness of these types of risks between the U.S.-China dynamic.
You mentioned, Nate, you touched on earlier about how much the U.S. depends on China, and in a recent UNCTAD report, it also talks about U.S. accounting for about 18% of China's export market. So looking at these two countries, in your view, which country will be dealt a bigger blow should decoupling occur? Emily, do you want to take this, and Nate can chime in?
Unfortunately, I think as things currently stand, the U.S. I do think that the narrative tends to go in the other direction, in large part because of China's reliance on the U.S. for advanced technology. That said, like, there is a logic that one sees consistently in Chinese sources that's that like the relative harm from losing the most advanced downstream thing versus the relative harm from using the upstream thing that you need to make the downstream thing. You'd rather be in control of the upstream. That's like the foundational. In addition, Beijing has spent the past decades plus of its industrial strategy trying to diversify away from dependence, especially on the international system, but especially on the US or any given single player. And that's true of looking for other export markets. It's true of looking for alternate sources of supply. It's also true of securing partnerships with the international business community that can let it evade any regulations that are imposed by a government. And I think all of those reasons mean that China has steeled itself for a potential decoupling dynamic in a way that the US has not.
Yeah, I would just point to the semiconductor supply chain as a really compelling and timely example. So in the United States, we over the past couple of years, the political ecosystem has worked really hard to pass a CHIPS Act that's like the largest U.S. investment directly into the industry. And the move that we discussed earlier from the Chinese side in reaction, restricting exports of things like gallium, germanium, indium phosphide. These restrictions have a far greater impact on market capacity than the billions of dollars that might be flowing from U.S. coffers into the supply chain. So the fundamental advantage, the foundational advantage that China holds, the stranglehold that they have over upstream supplies into critical supply chains really produces a competitive advantage that for all of the advanced technology and all the innovative capacity that the United States, the market, is in a tough place to solve for. And we have examples of actors on the Chinese side, like Huawei, probably the target of more regulatory action than any corporate actor ever. They're doing quite well as a company, and in some of these domains that we're talking about that align with where China's blocking the export of upstream supplies. Those upstream supplies, instead of going to an Intel or a Micron or some European player, are going to Huawei and supporting their investment and expansion into new next generation semiconductor activities. And I think that story, this actor that was battered by U.S. regulatory restrictions, but still doing quite well and possibly getting a leg up thanks to China's restriction of certain exports at the upstream in this critical supply chain, I think serves as a telling example of where this balance might head.
Absolutely. We have a question, so I'll ask that, and it's directed at Emily, and the coverage you've written about China's attempt to dominate tech standards for interoperability of global systems. So could you comment further on this, an aspect of trade data digitalization?
Yeah, China's industrial and technological strategy have for some time put significant emphasis on shaping international technical standards. And this is seen as a way to encourage the internationalization of Chinese products, Chinese technologies, and Chinese norms. The short logic is that if Beijing can set the rules for how systems are going to develop, then China can have an inherent advantage in competing for them.
Yeah.
And I mean, this fits very neatly into the decoupling logic, because that's also part of how you lock independence. If, for example, China has set a technical standard in a given field, which means that operating in that requires compatibility with a Chinese technology, then that locks independence on that technology. I think like a very tangible example of this would be like rail systems. That if China has built out a system of international rail system, international rail system, then where are the cars going to come from? Probably from China. Where are the parts that those cars need? Probably from China, because that's what's compatible. And I think you can like take that more concrete thing and then apply it to the entire range of emerging global industries, technologies, what have you.
Thank you, Emily. And as we wrap up, I have a question here. Feel free, do want to share with participants if you do have any questions. We still have some time, so feel free to put them in the chat box and we will ask them. Is there another one I see here? No. All right. So I wanted to ask, it's taking this from your report, you talk about trade and investment, between China and the US appear positioned to endure, and you've touched on different aspects of that, so far in this call. We have the business community, which is incentivized to ensure this, but at the same time, you mentioned in the report that presently in the US, there's no single issue that generates bipartisan alignments, like a hard line against the Chinese Communist Party. So let's talk about that, seeming divide between the business community and politicians, and what, both sides want and what both sides are trying to achieve. Nate?
Yeah, I mean, I think the political reality is one that is responsive to a few different embers. And I think one is national security driven. So I think the politicians, political leaders, government have observed up close and personal the threat that the Chinese Communist Party poses across a whole host of instruments of power and fora of competition. So running from the military to the commercial. So I think that is a cause of difference, that the business community isn't necessarily factoring in those direct risks on a national security perspective, or the latent capacity that those risks have to impact market dynamics. There are examples where that's starting to be incorporated more rather than less, but I think in general, it's safe to assume that the political dimension is informed by national security to a degree that the business community isn't. I would also think that the political perspective is shaped by the American populace and popular interest, possibly to a degree more than the business community is. And that reality, I think, is actually the more troubling for the hope of any thaw in the relationship. I think that the political signals that we're seeing over the past couple of years are so clear and resounding because they do resonate with the American populace, and that reality, I think, guarantees that over the next, at least over the next year, likely the next couple of years, that we're likely to see if anything, increased tension and rhetoric from the political ecosystem. At the same time, the business ecosystem in the West, and certainly the United States more particularly, I think is more susceptible to the inducements that the Chinese government has at the ready. And the Chinese government has done a good and thorough job of leveraging those inducements, both in a positive and negative way vis-a-vis the international business community, like the export restrictions we've discussed, like the moves they've taken to have the international banking community more concretely embrace the Chinese marketplace. I think that those tools from the Chinese side are likely to increase. China's likely to be more willing to give up segments of non-sensitive parts of the Chinese market to encourage that embrace from the business community. And I think that's kind of the set of indicators or fora that really is getting at the core of where this geopolitical relationship between the United States and China is and will continue to shape and move global trading patterns. The delta and how that's resolved between political and corporate perspectives. I think that the more enduring structural features seem to be informing and shaping the political perspective. And I think that one, at least in the near term, is unlikely to reduce or move in a way that supports, or compensates or accepts the business perspective. So I think that we're maybe in for something of a rocky road ahead for the immediate term because of this fundamental disagreement or misalignment between these two different communities.
Quite a bleak outlook, I must say. We do have another question from Patrick Flynn. So the first question was from Colin Lowland. We have another question from Patrick Flynn, and it says, given the fact that some well-known Western academics and banks have been forecasting a struggling Chinese economy for the last few years, as a result of autocratic policies, the lack of FDI, a cooling domestic private investment. What do you make of that assessment? Do you agree, and how does it play into geopolitics and de-risking?
I think that there are some fundamental weaknesses. I think you can look to indicators like the ebbs and flows and the domestic property market, the balance sheets of some of those large real estate enterprises to see some degree of weakness and structural deficiency. But at the same time, China's role as the world's workshop is not disappearing. That affords like a base level of economic productivity that then gives the Chinese government regulators a base to lever in their engagements in the world in a way that I think is able to mask or obfuscate the structural deficiencies. It's been more than the past 10 years. It's been a generation of neoliberal economic thinkers going to China and espousing the need for reform and restructuring of the private sector, of decreasing the role of government. I think that Chinese regulators, economic planners, do have some degree of confidence in their state-led, enterprise-driven framework and model, and that it is afforded, some degree of capacity that exceeds our base level assumptions and recognition of potential deficiencies in how they're structured. So I tend to interpret the potential and prospective weaknesses of the Chinese domestic economy as a story that will remain at the sort of base level that it's at, but that the Chinese government has a skill set and toolbox that allows it to evade most of the near-term, short-term risks. It'll be fine until it isn't, as most economic unraveling goes. But I do think that the degree that the government has leverage from a base pool of resources affords it some capacity to navigate to what should be on some fundamental and structural basis choppy waters. I think that the government's well equipped to handle those potential risks, and I think has an appetite for risk that might also exceed some of our common assumptions about how their system operates. So I tend to discount the near term risks, even when confronted with, what I think are really compelling and foundational weaknesses that you can measure in any number of ways. And for better or worse, I think that's an enduring feature for some time in the Chinese economy.
I'd also just add
Sure.
that it's a perception play. Like, so much of the Chinese economy is bolstered by the fact that there's confidence in the Chinese economy, generally speaking, even if some think that's not the case, and therefore that there are capital inflows and there's investment from the international system. And if you reach a tipping point where suddenly that became the minority, the confidence in the Chinese economy became a minority as opposed to a majority view, and in a long-term way, that could be like a real concrete, or that could affect the balance, because what people think affects their reality.
As we wrap up here, so we've been talking about this price of dependency and the rhetoric and the reality of de-risking U.S.-China ties. As we look ahead, I think that was Nathan was touching on that shortly. Near term, long term, what does that outlook look like? I mean, in your closing remarks, and I'd like each of you to take this on, looking at the relationship between the two countries, and based on the implications you mentioned in the report from the capital markets, the corporate strategy, and the regulatory aspect, what do you foresee in the, let's look at the near term, where these two countries stand in the business angle and the political space as well? Nate, do you want to go first, and then Emily can?
Okay, I'll go first. Yeah, I think I would project moving forward in the near term that's going to be similar level of tension, fits and starts. So I think the political realities in the United States are going to produce some base assumption that the next 6 months to a year are going to be choppy waters at a rhetorical level. Though I would expect that the Biden administration is going to make various overtures in that window to even if quietly, try to generate something of a thaw, and certainly try to protect macroeconomic prospects. Because I think the political calculus from perhaps the incumbent perspective is to play nice to some degree to guarantee that the macroeconomic environment remains buoyed and produces positive sentiment when it's time to go to the polls. So I think that there are those countervailing political forces. But I would expect that the level of tension that we've experienced over the past couple of years is going to be sustained, and I would think that concoction of those competing political dynamics, I think, means that we don't resolve anything in the next year or two. There's no grand bargain between these two sides, and that there's a lot of kicking the can down the road in terms of resolving the fundamental disagreements and causes of tension that I think position for even bigger flare-ups or spikes of hostility, proxy conflict, of sharp breaking between capital market flows. And I think the one upside or positive that I'd highlight is that the degree that China has successfully implemented this plan to have asymmetric interdependence, to seize upstream sources of supply, means that as these tensions continue to bubble up, there's huge economic upside for solving those problems. So the international business community, if and when able to incorporate these risks and to begin to invest in ways that solve for the dependence that exists, so solving the supply chain challenges, applying innovation to develop new ways and cleaner and more efficient ways of extracting things that otherwise are only extracted or processed or refined in China. I think that generates an interesting set of business opportunities that then I think in turn produce an interesting set of thought exercises in terms of where global trade patterns shift to, because there will be solves happening all over the world, and those solves will produce new pockets of trading activity that help to balance out what I think may be a relatively challenging U.S.-China trading dynamic over the certainly immediate, and then I think over the longer term as well.
Emily, your concluding remarks?
I think I would just harp on that point of like technological change and the potential it has to inform this dynamic. And also just add, though, the other side of the coin to it, which is that China sees today's technological change and trends as potentially a chance to secure even greater advantage. In areas where China has traditionally been behind or been a follower, to use the fact that we're in the middle of a technological revolution to leapfrog or to overtake it around the corner and establish control over new technological ecosystems. So you kind of have two tensions in this era of relative technological change or uncertainty. And one is that trying to use that to increase its hand, its control, its advantage. And the other is that there's this new incentive that this be used as a way to reduce dependence. And both of those forces will likely play out, which is an interesting and a fun, I think, a highly uncertain battle between two potential futures.
Awesome. Thank you so much. Want to really thank Emily and Nathan for joining us today. Reminder, co-founders of Horizon Advisory. Thank you for the great insights and really engaging conversation. Like you said earlier, lots to unpack there. There are different moving parts to this conversation, and we look forward to seeing how it unfolds in the coming months and years. I'd like to say that this event was developed once again in partnership with Hinrich Foundation, and the AFPC is solely responsible for development of the content. And on that note, I want to thank all our participants as well for joining us today, and hope to see you at the next event. This brings us to the end of the educational program. Thank you so much, everyone.
Thank you for having us.
Thank you.